Are you sick of seeing your hard-earned cash sit in accounts with low interest rates? What if there were smarter, more productive ways to save your money that would help you get the most out of it and protect your financial future? Come with us as we find the best places to save your money, from high-yield savings accounts to new ways to spend. Where should you put your money to make sure it grows steadily and safely? Stay with us as we talk about the best ways to make your savings work harder for you. Savings accounts that offer a high rate of return. A meager annual percentage yield of 0.01% to 0.02% is commonly offered by the majority of traditional savings accounts. The annual percentage yield of high-yield savings accounts, which are primarily offered by online banks, can reach up to 5%. It is important to look around because your neighborhood bank or credit union can also offer high-yield savings accounts with attractive annual percentage yields. When it comes to earning income, high-yield savings accounts typically do not demand a minimum deposit, and you will have the ability to transfer funds into and out of the account as you see fit. The fact that it is so simple to access makes it the ideal location for funds that you might require in a hurry or on short notice, such as within your emergency fund. Since online banks have lower administrative expenses, they are able to pass the savings on to their customers in the form of higher interest rates, which is why they provide the best annual percentage yields APYs for high-yield savings accounts. The annual percentage yield of savings accounts is variable, which means that when interest rates rise, the of your account will also rise. When interest rates go down, the annual percentage yield of your account goes down as well. Accounts from the money market. A money market account, also known as a money market deposit account, is a hybrid account that combines the features and benefits of checking and savings accounts. It is also known as a money market deposit account. Additionally, the majority of MNs come with the ability to write checks, access to ATMs, and a debit card. Your annual percentage yield will be higher than that of the majority of standard and high-yield checking accounts. MMA interest rates may be higher than those of a conventional savings or checking account. At the moment, high-yielding money market accounts provide annual percentage yields that range from 3% to more than 5%. However, mixed martial arts rates are often unpredictable and change depending on the conditions of the market. Similar to high-yield savings accounts, the best annual percentage yields for MMS can frequently be found at online-only banks or credit unions. It is important to note that money market accounts are not the same as money market funds, which are a sort of mutual fund that invests in highly liquid financial products like cash and U.S. Treasuries. Deposit certificates. When you purchase a certificate of deposit, also known as a CD, you are required to deposit money into an account for a predetermined period of time, also known as a term, in order to get a predetermined interest rate. The terms offered by the majority of institutions range from 6 months to 5 years. Because of this, you should not make any plans to retrieve your funds during this time. Even though there are a variety of certificates of deposit CDs available, the majority of institutions offer classic CDs. When you start an account with these certificates of deposit CDs, you make a one-time deposit. Some banks require a minimum amount, and your money earns a predetermined amount of compound interest over the course of the CD's term. It is possible that a certificate of deposit CD will pay a greater interest rate than money market or savings accounts as an incentive for you to lock your assets for the term. Your yield will typically increase in proportion to the length of your term. For example, the annual percentage yield APY on top-yielding 5-year certificates of deposit CDs is higher than 4.5%. If you remove money out of a certificate of deposit before the end of the term, you may be subject to an early withdrawal penalty, which is normally equivalent to a few months' worth of interest. According to Bobby Rebel, a certified financial planner and author of Launching Financial Grown-Ups, it is preferable to select a certificate of deposit with a shorter term if there is a possibility that you may require the money sooner than you had originally expected. This is true even if the yield on the CD is slightly lower. Constructing a CD ladder is one approach to take advantage of increasing CD rates while also guaranteeing that you have consistent access to your assets. You can use this tactic to spread your money out across a number of certificates of deposit that have staggered terms. Checking accounts that offer rewards. One of the benefits of a rewards checking account is that it offers incentives to customers who open an account and achieve certain requirements, such as maintaining a certain balance or making a particular amount of direct deposits. The rewards may take the form of a cash bonus, cash back or an increased annual percentage yield APY. When compared to a high-yield savings or money market account, a high-yield checking account may come with a few more requirements, yet it may potentially provide a distinct set of advantages than other types of savings accounts. Even while the majority of high-yield checking accounts do not provide interest rates that are as high as those offered by savings or money market accounts that earn interest, you will still earn interest on your day-to-day deposits. Federal Savings Bonds of Series I bonds hit record high savings rates of 9.62% in 2022, but since then, they have plummeted to 5.27%, which is still a high interest rate considering the current market conditions. The interest that is earned on I bonds is calculated based on both a fixed rate and an inflation rate. I bonds are savings bonds. There are 2 times a year, in May and November, when the interest rates on bonds are adjusted. Because of this, if you want to secure a rate of interest of 5.27% for a period of 6 months, you will need to purchase a Series I bond by the 30th of April. People who plan to save for a very long time and who won't need to access their savings for at least 5 years are the ideal candidates for this interest-bearing account. Every year, you have the option of purchasing up to $10,000 worth of I bonds or as little as $25 worth of them. And you also have the option of investing up to $5,000 from your tax return into an I bond, which may result in a potential annual total of $15,000. I bonds are a secure option, according to Michael Ryan, a financial coach who has 30 years of experience working in the field of financial planning. If you have additional funds for unexpected expenses that you want to put away, an I bond is a good choice. If you have an I bond, you could be able to earn more money than you would with a high-yield savings account because the rates on the I bond might be greater. The disadvantage, however, is that you will not be able to withdraw your money for at least a year. According to Rebel, you are not permitted to redeem the bond for a period of at least 12 months, and if you redeem it before 5 years, you will lose the interest that was accrued for the previous 3 months. In addition, there is no need to rush to withdraw your money if you want to keep the interest that you have been earning. I bonds can be held for a period of up to 30 years. Bills issued by the Treasury. Treasury notes, sometimes known as T-bills, are one of the 4 different types of debt that the United States government issues for the purpose of funding capital projects like the construction of schools, highways, and bridges. This debt is utilized. The act of purchasing a Treasury note is effectively the same as lending money to the federal government in exchange for the opportunity to earn interest over a period of time. T-bills are a type of short-term savings instrument that can mature in a variety of time frames ranging from 1 year to 1 year and are often sold in increments of $1,000. If you find yourself in need of cash before the maturity date of the T-bill, you have the option of selling the note on the secondary market. Treasury bills are generally considered to be safe and low-risk investments due to the fact that they are backed by the government. It is possible that those who live in states or towns with high tax rates would find this to be an appealing feature because all earnings are exempt from state and local taxes. The purchase of Treasury bills can be accomplished in 2 different ways, either directly through Treasury direct auctions or through a bank or broker on the secondary market. It is during the bidding procedure that the interest rate is determined when purchasing goods or services directly from the government. You can purchase Treasury bills in the most straightforward manner by placing a non-competitive bid, which ensures that your bid will be accepted but does not determine the interest rate until the auction is over. Want to make the most of your savings and stay ahead in the financial game? Subscribe to our channel and never miss out on expert tips and strategies for growing your money. Start saving smarter today.